The transfer of shares is something that you'll look at in more detail in commercial law. But generally speaking, as I said, the share of stock is designed to be transferred. It's a negotiable instrument. A negotiable instrument means that you may transfer title that you do not own. If I, for example, took this phone, which is mine, if this phone belonged to a colleague in the next office, and I stole this phone from my colleague, and then I sold it to you, my colleague would be able to get that phone back from you because I do not have title to the phone if I've stolen it from my colleague. And I could not give you title to the phone because I can't give you something I don't have. I have no title. I'm a thief. I can't transfer title to you, and therefore you've never received title, and so the colleague who is the original owner of this phone can claim it back. Now, if rather than the phone, I were to steal a share certificate from my colleague, and I were to sell that to you, the share certificate would have vested in you with full title. I do not have title because I'm a thief, but negotiability means you do receive title, even though I cannot give it to you. And that is done to protect commercial transfer of negotiable instruments, shares of stock, checks, debentures, bonds. This is something, it's a decision made. It's not legally coherent, but it is a decision which has been made in all countries I'm aware of in order to protect financial transactions. If I transferred you a share of stock and it would be possible for my colleague to claim it back from you, proving that I'd stolen it and I did not have title, that means that every time I transferred stock to you, you would have to investigate whether I actually own it, which is time-consuming and disruptive. And so in order to eliminate the need for that time-consuming investigation, the law assumes negotiability of the negotiable instrument, which means that you receive good title, even though I cannot give it to you. The one exception there would be something like what we've already seen in Turkand and apparent authority. If there is some indicia which should put you on notice that I in fact am a thief and I have stolen the negotiable instrument that I'm trying to transfer to you, then you cannot turn a blind eye. You must conduct reasonable investigation. And if you do not, then it may be possible for the original owner to receive the negotiable instruments back from you. And that's the general rule with negotiability. But you'll look at this more closely in the course Commercial Law. Shares of stock transfer with great speed in the stock exchanges. Now, the Hong Kong Stock Exchange is slow because we have a tax on the transfer of shares, but average daily shares trades are in the millions, very, very high. Now, how is that possible? What we have is something which is a closed system. When a participant enters into a sell order and a buy order on the exchange, we have a matched trade. And a central counterparty will become the seller and the buyer for all parties buying and selling securities on the exchange. And then the central counterparty has control of accounts with the shares of stock in them and also with the cash in them. And because the cash and the shares of stock are kept on accounts over which the central counterparty has complete control, then it's possible for the transfers to be made on accounts within the system at extremely high speed. And this is then how shares of stock are sold in the stock exchange. And the system which is used to contain the shares of stock is referred to as CCAS, the Central Clearing and Settlement Service. And CCAS will be the real owner of many of the shares in listed companies. And occasionally you might run into CCAS as the plaintiff in an action because CCAS is the registered owner. This is something that I go into more in my course on financial markets. I'm using the futures exchange. That's why I've given you the graphic here of the futures markets. And if you'd like to know more about that, I can discuss it on the side. But for the basic course in company law, it's not necessary. So altering capital is essentially going to be an increase or a decrease in capital. Capital, remember, is not the money and assets or things of value that the company owns. Capital will be an accounting item. So capital is essentially what is called capital, the amount of value which is referred to in the accounts as capital. And the capital need not be kept in a box or an account as cash. It can be used to buy assets for the company. If we looked at the life of capital in a restaurant, we may in the morning have cash, and then later in the day, that cash might have become partially food. And the food is then prepared and sold to paying customers and then returns as cash again. And then part of that cash is then transferred into salaries paid to the employees. And the salaries then mean that the employee will return yet another day in order to help transform the cash, which is in accounts, into fish and meat and vegetables, which are then cooked and prepared and sold to transform them back into cash at a profit, and salaries are paid again. And so the capital of a company will take various forms at various stages and various positions in the company's life cycle, and need not be gold coins sitting in a box and someplace buried in the basement. It is something which circulates. The one rule for share capital in terms of circulation is that it may not return to the members except as provided for by law. And we'll look at that in 2 weeks when we talk about capital maintenance. So when you pay in funds to the company and receive your stock back from the company, you are creating share capital. You've received your share of stock. What you paid in is the payment for that share of stock. And so that payment is share capital. Profits also can be capitalized, and that's where the accounting aspect comes in. So if profit is made from, let's say, selling the food at the restaurant, and that is profit which could be paid out to the members as dividends, But the members decide, no, we want to make our restaurant larger, or we want to advertise, or we want to hire more people. And so we want to keep those funds in the company. We can take that profit and then simply add it to the capital account. Nothing is changing in terms of the amount of money the company has, but we're calling the money that was called profit, now we're calling it capital. And so then the profits have been capitalized and the capital increases. The same can happen if we were to reduce the share capital, then we would call the amount by which we reduce the share capital profit, and that could be paid out to the members. As I mentioned, that kind of reduction is subject to strict restrictions in the law because the share capital is understood to protect creditors. Remember the game that I showed you with the Articles of Association 2 weeks ago, where something like the fox, the chicken, and the grain, you don't put the chicken and the grain together because the chicken may eat the grain. You keep things separate. And so the rules which allow you to decrease the capital are taken away from the members and put in the law, because those rules are designed to protect the creditors. The creditors don't vote in the company. The members do. So if those rules were in the Articles of Association, the members could simply vote away the rules, give themselves the cash, and then the creditors are damaged. So if you have a group which is protected by a particular rule, you make sure that the group which could damage them is not able to change that rule. That's why directors do not amend the Articles of Association, and why shareholders or members do not amend the rules on reduction of capital, because those rules are designed to protect the creditors, and the restrictions in the Articles of Association may be designed to protect the members. So Section 170 lists quite a few ways that capital can be altered. It can be increased by allotting new shares. So 1,000 shares are sold for $1 apiece. $1,000 is put into the share capital, and the share capital increases by 1,000. It can be increased by providing more capital. So the members all decide, all right, we're going to contribute another $1,000 to the company, even though we won't receive more shares. Profits, as I explained, can be capitalized, and then money which was called profit is now called capital, and the amount of capital increases. The capital can be changed by issuing bonus shares. So in this way, we have a capitalization of profits and also an issue of new shares on the basis of that capitalization. The denomination can be changed by converting paid-up shares into larger or smaller number of shares. So we can split the shares or combine the shares. If the shares were trading for $1 each and that seemed to be cheap, we could simply combine the shares, 3 shares into one, and now the shares are trading for $3 each. And they seem a little bit less cheap. And then shares can be canceled and the funds repaid. Shares can be repurchased and the funds repaid. And both of those would be a reduction of capital, which would require extensive approvals that we'll talk about in 2 weeks, week 6. So the formalities for altering capital are relatively straightforward as long as we're talking about an increase. Okay? So remember that an allocation of shares to a new investor is an increase in capital. And so we have the same increase requirement that we already saw. An ordinary resolution for the increase in capital. If we have a redenomination of the shares, it can't change the members' rights. Notice should be given to the company's register. This is the return on capital, right? And if there is a restriction on the cap in the articles that shares may not be redenominated, or that no new shares may be issued, then that restriction would have to be changed before the allocation or the redenomination could take place. And then, as I said, reductions of capital are a whole new area because we bring in creditors into the picture, and the law protects the creditors because they cannot protect themselves within the company given that they have no voting rights. A creditor can protect itself before lending money by making sure that the contract by which the money is lent is advantageous for it and protects it. But beyond that, there is no protection. And if we have what are called ordinary trade creditors, like employees, often the contract will not be strongly negotiated. Think about it. If you are applying for a job, or where you're working now, if you are working, think about whether you asked your prospective employer at the time of the interview where the funds would come from by which they would pay you. Did you ask them to show you their balance sheet? Did you ask them to put away funds to make sure that those funds would be available to pay your salary? You probably didn't. And so the law does that for you by requiring the share capital to be protected. Now, the share capital, because it can be really any figure and it doesn't all have to be paid in, is not terribly protective in any case, but it is a minimum of protection that the company's ordinance gives to creditors. That's the end of this lecture. It is a lecture on corporate finance. What we've seen is how the company can raise money by selling shares of stock to the outside world. People then become members of the company and they have the rights and duties which the share of stock conveys upon them. Once the company is established, there are rules to protect the existing shareholders. They must vote to allocate shares to a new shareholder coming into the company. We didn't look at classes of shares. Classes of shares are extremely interesting, and a class of shares allows you to adjust the income flow and the voting rights of a given class of shares in order to meet the needs of a given type of investor in a company. And classes of shares will be our topic of discussion next week. So I look forward to seeing you in class and working through the law application problem later.